All right, I think we're hold on.
I think
Yeah,
so.
we're good.
Well, good afternoon, everybody. Thank you for joining us. If you aren't familiar with me, my name is Deb Kelly. I am a financial advisor, certified financial planner with Potomac Financial Group, and we are an independent group of under our broker dealer Raymond James. And we're excited to to be presenting Investing 101 to you today. And I also have Greg Wilkinson joining us.
Good morning, everybody. I know there are a few of you out there that I've probably already met. To those that I haven't, I look forward to meeting you throughout this year. As Deb mentioned, I'm a new advisor with the office. I started back in January, and I'll be helping Deb out for the near future. So looking forward to meeting the rest of you.
Yeah. And by the way, not only was Greg the newest addition to our office here at Potomac Financial Group, he was also the first addition to my family, as in he is my son. Just to fill you in on that.
Yep.
And I'm excited that he joined us. So
All
we
right.
jump right in.
All right. So as Deb mentioned, today we're going to be talking about Investing 101. We've had a number of people request it, and we're going to keep this at a beginner level. So it's really going to be a high level overview. We're not going to be going too complex or in depth into any of these topics. Of course, if there are any questions you have, you can always reach out to us. We do plan on doing many more of these webinars in the future, where we will be doing more of a deep dive into some specific topics around some of the investments that we'll be talking about today. So a quick look at what we're going to talk about. We'll begin with an introduction to investing, just setting the stage, talking about what investing is, why you should be investing, and a couple of basic principles. We'll then go into the various types of investments that you might hear about during the conversation with us, or if you were doing research on your own. And finally, we'll wrap up with some of the things that you might think about when it comes to building an investment portfolio that's fit for you and your needs. All right, so let's go ahead and jump in. So, Deb, if you want to go ahead and kick it off.
Okay, so here we go. What is investing? So you hear about it all the time. Many of you are already doing some investing of your own, and maybe some of you are just starting out. Investing is actually buying assets with the expectation of growing those assets, generating income, making a profit over time. And the way you can do that is you can earn returns through some payment of interest. So some investments have interest, similar to your bank account. You might have some interest being paid in that. Dividends. Some stocks will pay dividends, and then there capital appreciation, which is just generally the market's improving, your money growing. And you can buy stocks of companies. You can have bonds. We call that fixed income. You can have assets such as gold. You can have real estate. Those are all forms of investing, owning any of those things I just mentioned. And it doesn't equal savings. There's some risk that comes in along with investing. And depending on how you how you invest, that risk will actually change, as will the reward for investing. Now, why would one want to invest? Well, wealth. Who doesn't want wealth? And so that, we want to gain more wealth. And, wealth is, you can buy things that you like, what you want to do. You can support your financial goals, your retirement, your home purchase, things like that. It's important that you outpace inflation. So we've seen a lot of inflation the last few years, and your money is just not buying what it used to. So you really need to invest in order to outpace. You can keep up with inflation, or better yet, outpace. And we're going to be talking about that in a few minutes. Financial freedom. Who wants to be burdened with, money problems? So having a little bit more freedom financially, and then taking advantage of compound interest. And Greg's going to touch on that in a few minutes. That's so key when it comes to investing. It really enables you to grow your money much more quickly.
And before we jump into the specific types of investments, Just a couple basic principles that, this isn't a complete list, it's not exhaustive, but just some basic tenets that tend to govern someone's investing philosophy. Now, risk versus reward, this is central to the decision in how to allocate your money. So, as Deb mentioned, there's the balance between risk and reward, and there's a trade-off here. So, do you want to earn more money? You want the potential to earn more money? You're going to have to take on more risk. We'll go into this in more detail later on as we talk about the different types of investments, the pros and cons of them. But that is central to investing, is that a higher potential reward is going to necessitate a higher risk that you take on. Diversification, I'm sure you've all heard this before, not putting all your eggs in one basket. Now that doesn't just mean investing in different types of stocks. So, I invested in, large cap stock A and B. That's not what we mean. It means different types of stocks. It can be different types of bonds. It's how you allocate your money between the different asset classes that we'll go into more detail on later on. And this plays into your risk versus reward. So the total risk of your portfolio, diversification is how you can lower your overall risk and not be exposed to the potential for losses that you can't handle. Compounding interest, Deb mentioned that, but it's the idea that with an investment, you earn some money, whether that's from an interest or dividends, things of that nature. And then that money that you've earned continues to earn money on that in the future. So if you're looking at 1 or 2 years, it might not seem like much, but when you look out 10, 15, 20 years, you'll be amazed at how much compounding interest makes a difference. There's actually a famous quote that is argued whether this is actually authentically from Albert Einstein. It's hotly debated, not necessarily likely that it was actually him that said this, but it goes something along the line of compound interest is the eighth wonder of the world. Those who understand it benefit from it. Those who don't pay for it. Something like that. Again, I can't actually quote him on it, but it's just a little fun anecdote that people like to quote. And then your time horizon. It's important to understand the time horizon you're working with, and that's going to be a major factor in how you decide to invest. This can be the time horizon for short-term goals, such as buying a car or a house within the next 5 years, or your longer-term goals, such as retirement, estate planning, leaving a legacy for yourself, things of that nature. All right, so let's go ahead and jump into the actual investments themselves. Let's give you some context into things like stocks, bonds, mutual funds, ETFs, and what they really mean. Because I'm sure you've heard of all these before, and you probably have a lot of questions about what they actually are. So we'll go ahead and start off with stocks. So when you think of a stock, so a company, they'll want to issue stock to raise money. So if I'm a company and I want to raise money for growth and expansion, there are a number of ways that I can do this. We'll get into another popular method later on, but the first one we'll talk about here right now is issuing stock. Now, when I issue stock, it's when I'm selling a portion of the company. So each stock or share represents an ownership interest in the company. And as an owner of the company or a shareholder, so when I say a stock or a share, it's a share of the company. Shareholders, you are entitled to certain rights. You may receive a portion of the company profits if they decide to distribute any dividends. And that's not always the case. Certain companies are more likely to send out dividends, whereas some, your growth and tech stocks, they tend to reinvest in the company themselves. But as a shareholder, you are entitled to potentially receive a portion of the company if the company declares one. And you're also entitled to vote on certain company rights, certain company matters. Now, this can be the issuance of additional shares of stock. It can be electing the board of directors. However, you're not voting on running the company. You're not making decisions on the operations, anything of that nature. And then stocks, how do you go about buying a stock? So there are, I'm sure many of you have heard of the New York Stock Exchange. There are a couple different markets. So when a company initially issues stock, it's issued through the primary market, which is through typically an initial public offering, so an IPO. You've probably heard of an IPO before. This is when the company first issues shares. And then something like the New York Stock Exchange, where if you've been on a brokerage app and you bought a share of some company out there, that's likely through what's known as the secondary market, where you're buying it from someone that already purchased that share in an IPO. So the primary difference here, in an IPO, the company itself is actually seeing some of that money from the proceeds of the sale, whereas in the secondary market, that is just traded secondarily through individuals outside of the company. So let's talk about a few of the benefits of stocks. So a couple here, again, this is not an exhaustive list, but three that we think of. So capital gains, this is the potential to sell the stock for more than you purchased it for. So that's one way you can earn money by investing in stocks. There are dividends, which we mentioned before. A company may elect to pay out dividends, which are profits of the company that they distribute out to their shareholders. And then a major benefit of stock that we'll show in some charts and some other examples is its hedge against inflation, its ability to outpace inflation, like I mentioned before. And over the long term, we've seen that stocks tend to have higher returns than the other asset classes that we're going to. So here's a quick example of that. For instance, how many cartons of eggs could you buy with $10 today versus in the year 2000? So in the year 2000, where eggs were under $1 a dozen, you could buy a little over 10 dozen eggs with just 10 bucks. Today, with inflation over the last 24 years, eggs sitting at $2.70 a dozen, you can only buy 3.7 dozen. So the key takeaway here is that if you have money and you're not investing it, over time, it's going to lose its purchasing power, which means with the same amount of money, you're going to be able to afford less. And this next chart shows it even more. So this is a chart that we put together. This is going to show the inflation adjusted returns for, so the S&P 500 up there, that is an index of the 500 largest companies. If you were to take $1,000 in 1990 and you invested it into the S&P 500, you invested it into bonds, gold, and then you just kept it in cash in those four scenarios. So if you kept it in cash, that $1,000 in 1990 would only be able to buy about $430 worth of stuff today. Now, it doesn't mean that your cash is actually reducing down to $430. It's just the amount that you can buy is equivalent to only $430 at that time. Gold, you can see, would appreciate by about 120%. Bonds 132%, and then you can see stocks there 479% since 1990, and that's adjusted for inflation. Now the kicker here, you can see that trend line with the stocks is a lot more volatile. You can see a lot more ups and downs. You see bigger declines. So while stocks do tend to appreciate much greater than those other asset classes in the long run, there are periods of time where you may see some declines that might put you in a bad spot if you need that money. So that's why it's important to diversify and understand your risk tolerance, the goals and objectives you have with investing, and deciding how much you actually put towards your stocks to make sure that you can make it through these periods like you see in 2000 for that dot-com bubble crash. A lot of people lost out on a lot of money on paper. But again, a lot of pros here with stocks, but again, you have to make sure that it fits your risk tolerance and time horizon.
Right. And he mentioned time horizon, and that's something that we often talk about. And we'll talk to clients about when do you need this money? And you might have several baskets. You might need a portion soon. So we're going to take on a little more less risk simply because you saw those ups and downs on that last chart. But if you have a longer time horizon, you can withstand that choppy up and down because, as you saw in the long run, the trajectory is always up and to the right. So longer time horizon, you've got more time to make up for any of that volatility. So we always consider time horizon when investing.
Yep. All right. Now let's talk about a few of the risks of stocks, because there's always a pro and a con to everything. Nothing is always perfect. So with stocks, three risks that you're going to face here. So the one is market risk. This is the risk of losing money or for your shares of stock to decrease in value based on factors that are affecting the market as a whole. This can be global disasters. It can be wars. You know, we just went through COVID and we saw how crazy those couple of years were with the stock market. And this is something that, you know, is unavoidable. It affects just the market as a whole. There are also company specific risks. And this is going to be the risk of losing money or losses due to poor performance of the company, whether that's through management decisions, failure to meet earnings expectations. You know, maybe people were a little bit too aggressive in their expectations of how a company did, and even if they earn money, it might not meet what they were expected, and that can cause a temporary short-term appreciation in the value of a share. A company can go bankrupt, and you can lose all of your money. So these are all possible scenarios. And then volatility risk, again, as we showed on that previous chart, while we do tend to see stocks outpace other asset classes over time, you are putting yourself at risk of more volatility and over short time horizons. Stocks may experience greater price changes, so it's important to be aware of that. All right, so I mentioned stocks being one method of raising money for a company. Now, there's another way, and this is known as a bond. Now, if a company doesn't want to issue any more shares, or they don't want to have anybody else buy into the company, they can receive a loan for growth and expansion of the company, and they can issue a bond. And what a bond is, it's essentially a loan to somebody where the investor, the one buying the bond, is going to receive periodic payments of interest. And then at the end of the life of the bond, they're going to receive their initial payment as well. So there are three components of a bond. So there's the face value. So that's what you pay to buy the bond when it's first issued. So let's say I bought a bond for $1,000. So I pay a company $1,000. Then there's the coupon, or the rate. This is the percent that they're going to pay me every year. So let's say it's 10%, just for the sake of easy math, 10% per year. So I'm going to earn $1,000 $100. That's 10% of $1,000 each year. And then the maturity date. This is when the bond matures, and I'm going to receive my initial investment back. So let's say it was 5 years. So I paid the $1,000. In years 1, 2, 3, 4, and 5, I receive $100 in interest. And then at the end of the life of the bond, I'm also going to receive my $1,000 back. Now, bonds can be issued by companies. They can be issued by governments, local municipalities. So you'll see U.S. Treasury bonds, bonds from government agencies. You can have bonds from municipalities and states for, highways, stadiums, things that benefit the public. And you can have corporate bonds. Typically, bonds do have lower returns than equity-based investment or stocks, things of that nature, but they tend to see less volatility. So a few of the benefits of bonds, why you would want to invest in them. So income, I just talked about the coupon. So bonds provide regular, predictable interest payments. So you know what the face value was, you know what the rate is, you know that you're going to earn a certain amount in interest per year. Stability, I mentioned the volatility. There's less volatility in bonds than we typically see with stocks, especially when they're invested in government and high quality corporate bonds. How that's determined from the quality, I'll show you in a little bit. I'll go into that detail in the slide or two. And then diversification, when you're looking at the overall portfolio, bonds can help to reduce the overall risk of a portfolio that's heavily invested in stocks, as they tend to move inversely to stock prices. Now, a few of the risks of bonds. So there's interest rate risk. So as interest rates are changed, bonds are going to experience price changes. which can lead to a loss if they're sold before maturity. Now, this might be getting into too much detail, but all you need to know is that the price of a bond that's already been issued is going to change as interest rates go up or down. There's credit risk, and this is the risk that the issuer, so let's say I buy a bond from a company, this is the risk that company is not going to be able to pay me back. They're going to default on that loan. And this is especially seen with issuers for credit, which I'll go into on the next slide. And then finally, there's inflation risk. So I talked about how stocks are great at outpacing inflation over the long run. Bonds don't do as good of a job at outpacing inflation due to the lower expected return. So inflation can erode the purchasing power. So year 1 versus year 5 of a bond, I'm typically receiving the same amount of interest. So $100 in year 1 and $100 in year 5. With inflation, that $100 in year 5 is less valuable than it is. Okay, so I mentioned the credit rating of a bond. So just like we all have credit ratings, you know, if you want to go get a car loan, you want to apply for a mortgage, they're going to look at your credit rating and get a sense of how much at risk are you to not pay off the loan. Here you see Moody's, Standard & Poor's, Fitch Ratings. Those are a couple different rating agencies. And you can see from that top row down, those are the different ratings that they would assign to different entities that might assign a bond, or that might issue a bond, sorry. And what you can see in those 4 top columns, those are known as investment grade bonds. And as you go down to the lower quality, there's a higher risk of default. So that's like, let's say that top row, you're at 800 credit score. That middle row, you're in that 600 range. That bottom row is where you're looking at the low hundreds for credit. So think of it that way. And bonds typically have an inverse relationship between their rating and the yield or the rate they might offer. And the reason for that is if I have a lower credit rating, I'm going to have to offer a higher rate on my bonds. Because why would somebody invest money? Why would they buy my bond when I'm more likely to default than this other company if I'm not offering more money? So again, this is all that risk reward that we mentioned earlier. With more money, if I'm taking on more risk, I'm going to need a higher reward. So that's not to say that junk bonds don't have a place in a portfolio. It's just you have to be aware of the risk that you're introducing.
So before I get into what a mutual fund is, I want to explain what an index is. You hear that all the time. You turn on the news, CNN, Fox News, whatever it might be, Yahoo Finance, and you hear about the index. Typically, you're hearing about what's called the S&P 500 index. What an index is kind of like a yardstick to measure the performance of a group of stocks or other assets, bonds could be as well. The S&P 500 index, it's 500 large U.S. companies, what we call them large cap or large capitalization. Now, I don't want to get too technical, but the way they measure the capitalization of a company is they take the number of outstanding shares of their stock and divide it by the stock price. And a large cap stock is $10 billion. So these very large companies make up the S&P 500. And that is the index, the S&P 500 index. You cannot invest directly in that. You cannot call someone and say, I'm buying the S&P 500 index. But there are ways that you can invest in the companies that make up an index. So if we're talking about the S&P 500. So first, we'll talk about a mutual fund. And a mutual fund, well, imagine a large basket, and you've got an investment manager with that basket, and his basket is going to hold some of the companies in the S&P 500 index. But he, she, they are not going to invest in every company in the S&P 500. They're going to use a lot of research and use their expertise, and they're going to decide which companies they feel are going to outperform the S&P 500 index, which are the best performers moving forward. So they might have guidelines that they have only 100 companies or whatever the guidelines are set up for that mutual fund manager. And they're going to use, again, their expertise, their research, all of that to decide which 100 companies to throw in that basket. And that is a mutual fund. It is a basket or a pool of money from a lot of investors. Well, it's a pool of money from a lot of investors that is invested in that basket. It's a diversified portfolio. And again, it depends on the fund's objective. It might be S&P 500, which is those large cap companies. It might be international companies. It might be a very broad base. It might include US internationals. And you can also have it for fixed income, those bonds that Greg was talking about a few minutes ago. Again, imagine a basket. The mutual fund manager is throwing everything in that basket, or what they think are the best in that into that basket. And that is what the professional fund managers do. There are over 8,700 mutual funds available, and objectives, you can name it pretty much for anything you want. If you want to invest in a certain country, there's going to be a mutual fund. If you want to invest in a certain industry, there's going to be a mutual fund. So things are wide open there. And with a mutual fund, which makes it different than the stock exchange that Greg was talking about earlier. So you buy an individual stock on the exchange and it is transacted. As soon as you hit go, that is purchased or sold. So it's on the exchange throughout the day. Mutual funds, on the other hand, those trades are executed once a day after the market closes. So mutual funds do not trade on the exchange. They trade after hours.
And just to go back to the market cap as a quick example, just to give you some context, if you were to see a company that had $1 million shares out, or sorry, 1 million shares outstanding, and the share price was $10, you multiply the two, you would say that their market cap was $10 million. Just so I know, like you might look online and see, oh, their market cap is $37 billion, and you don't understand what that means. That's really all it is.
And thank you for saying that, because I think I said divided by. I think I'm thinking about RMDs or something. Anyhow, okay. Next is an ETF, or exchange traded fund, also known as an index fund. And with that name, you can imagine an index fund or an ETF. It's an investment, and it's going to hold all of the investments, all of the companies, or all of the fixed income within a particular index or sector. So if you're buying an index fund or an ETF of the S&P 500, you're going to buy one that mirrors the S&P 500. So there is a management company that is going to form these, and there are quite a few out there, and they're going to buy everything in that index, everything in the S&P 500 index, if we're going back to that same example. And they're going to put all 500 of those companies into that basket. So instead of holding, say, 100 or whatever it might be in a mutual fund, you're going to hold everything within that index. Now, they do offer greater liquidity, because unlike mutual funds that trade after the stock market closes, they're traded just like stocks on the exchange. So they're traded whatever time during the day, you put in an order, they're traded. And now I mentioned that you've got the investment managers using the expertise and all of that on a mutual fund. In an index fund or an ETF, as I said, they buy everything within that index. So they don't have to do as much research, or they don't have to have quite the same expertise level. So they have a lower internal cost, what we call expense ratio, because you're not paying the managers for all of their expertise. It's much more passive styled management. So the internal fees are lower there. That being said, they're also typically, or can be, more tax efficient than a mutual fund, because they're buying everything in an index, and those indexes don't change quite as often. You've got F500 in the S&P 500. That's not changing on a daily basis. Whereas a mutual fund manager may say, you might find one stock that's going to fall out of favor. He may say, or he, she, they, whomever it is, it might be a team, they find a stock that they prefer over one that's currently in the fund, so they might swap them out. So they're making trades much more often. So if they have gains in a trade, there might be some taxation there. Just a lot of different, the tax efficiency is a little bit different, more tax efficient in an index fund. Benefits of mutual funds and index funds, or ETFs. diversification. So we talked about buying an individual stock. Well, if you buy an individual stock, does well, great, market goes up, it does well. But if it goes down and you only have one stock, well, that could be a problem. You're going to do pretty poorly. But if you diversify and you have an index fund with 500 companies or a mutual fund that too is diverse, perhaps not quite as diverse, and one of those stocks, the prices falls, well, you've got all the other ones still propping the price up. So it lowers the risk by spreading out the risk amongst all of the securities within the in that basket, whether it's a mutual fund or an index fund ETF. Accessibility. You might be able to invest in a large number of companies with a smaller investment amount. You know, you look at the price of some of these stocks, and if you wanted to buy one share of, you know, heck, a couple of months ago, we're looking at NVIDIA and the price of NVIDIA. It was, you know, $1,100-$1,200 for one share. Well, if you bought that within a mutual fund, you're pooling your money with all these other people. You're buying many other investments. You can have access to NVIDIA. You could have had access. Maybe you had $1,000. You'd have a sliver of NVIDIA making up that portfolio. So you have access to many more investments with a smaller investment. And then I've already been talking about professional management. You know, they have much more expertise than your average retail investor. So relying on professional management, even beyond an advisor such as, you know, me or Greg, you know, their professional management of their funds, your average retailer is just not going to beat that. Now, of course, there are downsides to mutual funds and index funds. There are fees, and I mentioned those, the expense ratios on those. And that's for the management of those investments. The fees typically being higher in a mutual fund because, you know, they need a little more expertise when they're selecting what they want in the basket. And index funds also have those expense ratios or the fees, but they're lesser. And then control. You're not going to have the same control if you're within a mutual fund. You can't specify what you want bought and sold within a mutual fund. You can buy and sell a mutual fund in general as a whole, but not the underlying investment. So you lose a little bit of control there. And then the taxation. It's tough to see. You don't see the taxable events that are happening within a mutual fund or an index fund, any trades that they're making, if there's going to be any tax liability, you don't see that on a daily basis. So you only see some of that if you sell the fund, and then also at the end of the year, you might see some capital gains distributions. But so the taxation is a little bit different with those. And here we go, diving a little bit deeper into taxation. So I mentioned capital gains distributions, but capital gains, that is when anything but within a mutual fund, when their stocks, bonds are bought and sold throughout the year, if they're sold and there's a gain, you're going to have to pay taxes on that gain. Short-term gains, those are if you've held them for less than a year and it's taxable as ordinary income. This is the same within a mutual fund. Investments sold within or bought and sold within a mutual fund that you, again, don't have much control over. Or if you're buying and selling individual stocks, short term, less than a year, it's taxable as your ordinary income, just like you received that gain in a salary. Long term is if you've held it for at least 1 year and you are liable to pay the capital gains tax rate, which is typically 15%. So you do have a tax advantage if you do hold investments for at least a year when it comes to capital gains. And this is going to apply to stocks, mutual funds, index funds, ETFs, bonds that are sold prior to maturity. If you hold a bond to maturity, you don't have the capital gains taxes. But again, these short-term, long-term, and it applies to all those various investments. You're also potentially liable for dividends. So Greg had mentioned, like, there are value stocks, and value stocks are those that pay dividends. So when they have profits, the companies have profits, they distribute them to the shareholders in the way of dividends. So a qualified dividend which most of your dividends that you're going to see in a U.S. Stock in particular, and U.S. mutual fund, it's taxed at 20%. Non-qualified dividend, it's taxed as ordinary income as if you got it in your salary again. And this is going to be for stocks, mutual funds, and index funds. And you will get tax reporting early in a new year for anything that was any trades, well, any gains, any dividends, any interest income from the prior year. So you'll get those in late January, early February, typically, for you to report on your taxes. And it will be spelled out whether it's qualified dividends, non-qualified, short-term, long-term capital gains, all of that. And then the last bit of taxation is interest income. And this is going to be on your bonds. So we talked about you're going to earn all the interest on these bonds. Well, if it's a corporate bond, so buying part of a company, or excuse me, a bond of a company, it's taxed as ordinary income for both federal and state. So just like you received it in a salary for both your federal and your state return. If it is a federal or a government issued bond, it is federally tax-free, but you're going to be taxed as ordinary income for the state. But then there is a municipal. So if it's a local government, or if then it's going to be taxed as ordinary income for the state, exempt from federal, similar to above. However, if it happens to be a municipal bond in the state that you reside in, so if it's a Maryland, if you live in Maryland and it's a Maryland municipal bond, it is exempt from federal and also Maryland state taxes. So it depends on where the bond is issued and where you live as to whether or not you're going to have it as a state tax-free. And bonds, mutual funds and ETFs, but they would have to be bond mutual funds and ETFs, index funds.
All right. So we've talked about some of the basic principles of investing. We've gone through the different vehicles. So how do we put this together and think about building what we would call an investment portfolio? So we'll talk about what we're talking about when we mention an investment portfolio. We'll go into risk tolerance, how that plays into the investment that you want to include in your portfolio, asset allocation and diversification amongst the different asset classes, few common mistakes of your average retail investor, and then we'll finish up with just a brief one on goal planning and monitoring. So with an investment portfolio, we're talking about all the assets held by an individual, and this is not, it can be your retirement plans, it can be any assets you have in a brokerage account, 529 plans for any kids that you or relatives that you want to invest for their high school, college tuition, real estate investing. It can be your checking and savings accounts as well, because that's going to play into your portfolio of your investments and how you need to allocate your money. So again, we're not just talking about your brokerage account or your retirement plan. We're talking about the holistic view of your financial health across all of your different accounts and portfolios. So you mentioned risk tolerance before, and we talked about the balance between risk and reward. With a higher expectation of reward necessitates you taking on higher risk. Before you start to build your investment portfolio, it's critical that we work with you to develop a real understanding of your risk tolerance and how that plays in with your financial goals, to make sure that we're building a realistic financial plan and an investment portfolio that fits your specific situation. And the risk tolerance is going to vary from individual to individual. So, as we talked about the time horizon, so younger investors versus older investors might have different weightings between equities and bonds. But what we're talking about here is with an individual. So you can have two 30-year-olds with the exact same family situation. They have two kids. They have all of the same financial constraints and whatnot. This comes into the psychology of this. How tolerant are you to risk? How comfortable are you going to be if your portfolio declines 30% and you might not be able to recover that for 3 years? Is that going to make you sick to your stomach and you can't sleep at night? Or are you okay with that and you're willing to take on the risk knowing that you expect over the long term to be able to, get through those humps? And there's no right or wrong answer. It's all individual. So it's important for us to understand your risk tolerance so that we can build a portfolio that fits not just your time horizon, your financial goals, but also your individual appetite for risk, and make sure that you're not sitting there watching your account and just, feeling stressed all day, every day. We want to make sure that we are investing the right way for you as an individual. And again, greater returns require additional risk, and that's something that we will always stress. People will come in and say, I want to make this, and I want to be able to buy $1 million house in the next few years, and I have $10,000 to invest. Let's put together a realistic plan. So again, that's something that we'll work with you on.
And here's where the planning comes in. So diversification, I've already been talking about that, or we've been talking about that, diversification. So you might have diversification within a mutual fund, we said, adding, various different stocks or bonds to the basket that the manager owns. But it goes even further than that. Diversification, spreading your investments across a variety of asset classes, or having multiple baskets, multiple of those baskets that we talked about. You might have the S&P 500, and then you might have internationals, and then you have your bonds, your fixed income. And so it's spreading everything out. The asset allocation is actually the percent that's invested in each of those baskets, so to speak. The asset classes based on your goals, your risk tolerance, and your time horizon. These are all things that we've been talking about throughout this. And depending on all of those, your goals, your risk tolerance, and your time horizon, we're going to have different asset allocations. And we can have one client maybe entirely in a moderate allocation. And what that would be is about 65% is the dark blue would be in stocks, but it would be a variety of stocks, a well-diversified group of stocks. 30% might be in fixed income, which is those bonds. Perhaps 5% is in cash. We call them cash equivalents. But so that would be a moderate allocation. But I might have another client who's much more aggressive. They're not going to lose as much sleep at night if the market does drop, knowing, maybe they don't need this money for another 10 years, 15, 20, whatever it might be, to retirement. So they can be a little more aggressive. So their allocation, meaning the amount they're taking in stocks versus bonds, is going to be more aggressive. And in this example, an aggressive allocation has 85% in stocks, only 10% in fixed income. Then you go the opposite direction and you can be rather conservative and take on less risk, knowing that the reward won't be as great because you're taking on less risk. And we can have multiple allocations for an individual client. We talked earlier, Greg put up that graph with the inflation and the way that the S&P 500 was way up 486% or something like that versus your cash, gold, bonds, much lower percentage. Well, if you need something short term or shorter term, you have a shorter time horizon, we would likely go more conservative for that money because you can't withstand the ups and downs that you're going to see in a short period of time. However, if you have a much longer time horizon, we could have an account that's much more aggressive. So if you have one account that is specific for one goal, say retirement, we can invest a certain way. If you have another that is for that house that you want to buy in a year or two, we would go more conservative in that. So we can have a variety of asset allocations within a portfolio, but we really need to figure out where you need to be invested, stock versus bond wise, risk wise, when we come up with a strategy that's tailored to you personally. Now, there are certainly a lot of pitfalls. First one being chasing trends, following social media. And we got FOMO, the latest and greatest term out there, FOMO, fear of missing out. Well, you see something on social media or on the TV, what have you, and you say, I've got to do this, I've got to do that. And you're listening to the media, just following these social media trends. beware, because they don't typically work out. And chances are you might be too late to the game. If something was successful that was shown on social media, you may have missed out on it. Obsessively watching the markets and panic reacting on negative news. Looking at your accounts every day is fine, but panicking, especially when you hear negative news, if you in early August paid attention to the news and you saw that, we had a very difficult couple of weeks. And if you panicked and jumped out of the markets, you would have missed on some of the best days we've had. We've had a fantastic week and a half just recently. So don't react on the negative news. If you're working with an advisor, you're working with me and Greg, we're going to have you invested appropriately so that you can kind of ride out those negative times. Timing the market. It's investors try to do this all the time. And I mentioned earlier about the professionals knowing more than your retail investor. This is where that really comes through. So what you really want to do is buy when the price of a stock is low or a fund, and you want to sell it once it's high. But unfortunately, more often than not, your retail investor is going to do the opposite. They're going to go and they'll see the wave of strong performance, get all excited, want to jump in, and they'll buy when that stock has gone up, skyrocketed. So now they want to get in. So they buy when it's high, but then what happens? The market drops, they panic, and then they sell. And that is the opposite of what you want to do. And you always need to make sure you give your investments time to grow. You already saw how choppy the markets can be. Let them grow. Invest appropriately. Follow your time horizon. Your investments are going to be, allocated according to your time horizon. Follow that time horizon. Let them grow. And stick to your strategy. If you work with me and Greg, and we come up with a strategy that works for you, whether you have a couple different accounts with different strategies within them. We know what your goals are. We know what your time horizon is. Stick to your strategy. Again, too many ups and downs in the market. It'd be too easy to panic. But if you have a strategy in place, stick to it, ride it out, and you'll reap the rewards of doing so rather than panicking. So we talk about how we try to, we're going to set your asset allocation. We're going to help you figure out how you should be invested. It's going to be personalized to you. Well, the tool that we use is goal planning and monitoring, and it's going to help us set, monitor, and achieve your financial goals. We actually will input a bunch of data, what your expenses are, what they're expected to be, say in retirement, if that's your goal, which that's the goal of most people. That's what we're all aiming for, be, financially set in retirement. And then we'll look at your income sources, and we'll look at your assets, and we'll also look at your risk tolerance. What's going to make you lose sleep overnight or at night? If we experienced a drop like we did in 2008, which we called the Great Recession, we had a Great Recession. This is what your money would have done. Ideally, we don't have another Great Recession, but if we were to, this is what your account would have done if we're invested this way. Can you make it through that? Are you going to panic, or are you going to be able to, stay the course? And then we kind of, push a button, we throw that all in, push the button, and there's a dial. And what we're trying to do is get you in the green zone in the dial. If you're in that green zone, we feel very comfortable you can meet all of your goals that we've set, all of those expenses that you want or will need to have in retirement. If you're in that green zone, we think you're set and you're invested appropriately. But we might also see that perhaps you're not invested aggressively enough, or you're too aggressive. So we're going to adjust your asset allocation with a little help from goal planning and monitoring. This is a really great tool, whether it's looking at how we should invest your money with your goals in mind, or do you think you can buy that boat in retirement? What is some of the goals that you want to, what are some of the goals you want to achieve? Let's figure out how we can get you there. So if you have not used goal planning and monitoring with us and would like to, be sure to let me or Greg know, because we're happy to do so. But this is the tool that we use on an ongoing basis with clients to make sure you're invested appropriately for your own situation.
All right, well, that just about covers it for what we had for you today. Again, this was intended to be a very high level overview for those new to investing or those that just had some basic questions. If there's anything that you want to go into more detail on, or you have any questions, here's our contact information here. And I just want to say, appreciate everyone joining today. Again, we plan on hosting a number of webinars in the future as well. We'll continue this series, so be on the lookout for future invites.
Absolutely. And if you have any topics that you'd like to hear us talk about, you'd like us to address, we're happy to do so. And, or if you want to share this with someone else, this is going to be on our YouTube page. And we will send this out to clients as well.
All right, well, that'll do it for us. Again, if you have any questions, feel free to reach out to us at any time. And on that, hope you have a good rest of your week, and we'll talk to you soon.
Thanks for joining us.
Take care. Bye.